Morning, Market Chameleons. Happy Thursday to everyone. And there he is. King Chameleon.
Good morning, Will. How are you?
How you doing, buddy?
Pretty good. So ready for another Q&A?
Yep, we'll do a Q&A and hopefully some questions will come in. I think we may have some questions left over from yesterday, but let's start with the disclaimer. What do you think?
Sure. Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. Excellent. I did, so everyone knows, I put out the link to the Zoom meeting. We had a great live question from a new chameleon yesterday. I think Michael, I think his last name was Sasser, came on and asked a couple good questions. The live questions do seem to promote more in-depth answers and get to more questions. So anyone who wants to come over live, if you're uncomfortable giving your name, that's fine. Just come over, raise your hand, and whatever you type into Zoom as your character, that's what we'll refer to you as. So with that, D, we can get started.
Yep. So I'll share my screen, and while we're waiting for any questions to queue up, I'll just start kind of going over the pre-market report. Maybe mention something about yesterday's question. I did forget to mention one thing that might be helpful to answer the question on gappers. So cover that. I have some other questions remaining that I get from emails or from previous reports. So until we get any questions coming up, I'll just start with those. Once the questions come in, I'll focus on that. And remember, this is your chance to come on live, ask the question, or you could type it in, but it's easier for us sometimes when you come on live, because when you put a question in, especially, if it's in one sense, if it's not a simple, if it's not like a simple question, like how do you find this or what is this, we might be misinterpreting what you're asking, because you're putting it in, and we might have to ask you, like, what are the surrounding circumstances? What are you looking at? Point to it. And this helps maybe, guide us to really answer your question more completely. So let's just start out right now, taking a look at what's moving to pre-market hours. And this is a report, stocks that are trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I see here 184 stocks made our percentage gainers list today, 39 made our percentage decliners list. From that perspective, it looks like a more bullish bias at the opening. I'm going to also just take a look real quick if we're seeing a similar picture in the higher market cap stocks. So I'm going to use this market cap filter. Let's do stocks that are 20 billion market cap or higher. Here we see 57 made the percentage gainers list, 9 on the percentage decliners list. So from that perspective, still looks like a more bullish bias at the open. Now, one of the questions yesterday that came up was on the gappers. When a stock, let's say, gaps up in the morning or gaps down, how frequently does it tend to close that gap? In other words, if it closed the previous day at 100, if it opens at 110, so obviously it just went right from 100, the next day it opens at 110, up 10%, right? What tends to happen to that stock when it gaps that much? Does it tend to close in on that gap, sell off? Is that like an opportunity where people take profits, or does it, from that starting point, does it continue to go higher? And there's no way for knowing for sure what will happen, because every situation is going to be different. It's going to be news driven. You got to take that into consideration, what's going on. But we could take a look at a historical perspective of a stock, and let's say, okay, here's a stock, it's gapping up 7%. And we could take a look at its history and see, well, what happens to this? I think this is Nokia. There's news on there, so you want to take a look at that news to see if anything's different. But we could just take a look at, from a historical perspective, historical gap up moves and what the stock tended to do after the opening. So here, I'm going to I have these historical tabs to help me out. So I'm looking at gap up history in NOK. So it's specific to this stock. And we're going to take a look at the 12 largest gap moves to the upside. So I'm going to come down here, and here are the dates to the left. There's notes here if there's news, headline news, if the market was up big and it was just in sympathy with the market. So here we see that the 12 largest gap moves historically, on average, up 7.1%, which is kind of in line, like right in line with today's. So here we see, well, what did it tend to do after the open? We know gap up. All right, if it opens up higher, if it opens up here where it's trading the pre-market, what did it do historically from that point? So we see that from the open to the high of the day, the average move was 10.4% up. And I do see here an outlier here up 96%. So I'm going to just come down here and look at the median move, because this average is pulling that average way up. I just spotted it with my eyes. So the median move from the opening to the high of the day up 2.5%. From the opening to the low of the day, the median moved down 3.9%. So you could see here that, gapping up doesn't tend even to the low of the day on average, where the median doesn't close all the way, right? And by the end of the day, it looks to me here that the drift more often than not, it drifts lower. 58% of the time it drifted lower, 42% higher. I mean, it's almost even there. On average, it gained 0.9%. But again, I'm seeing this big outlier move here this day. So I'm going to just take a look at the median move, 0.9%. So it looks like, it tends to give back a little bit from that opening gap. So that's another way of looking at it. Maybe it's not exactly the statistic, that was asked yesterday, but it gives you a close approximation. Well, we open up, what happens that day after the opening, and then we could kind of follow up and see the next day. Does the next day, if we gain on average 8% the day of, do we lose that 8% coming out? It looks to me here that even though coming out it tends to give back on average some, it doesn't give back the total gain for that day. So that's just really quickly another way to look, at historical price action analysis from a statistical standpoint. And this is Nokia as an example. So hopefully that helps a little bit with yesterday's question, but it came to me after the show, maybe after thinking about the question, something else to look at. Let me know, Will, if you have any questions. If not, I'll just kind of start out with my notes.
Well, I was about to type it in, but we can talk about it. I mean, Brad, who's on quite a few mornings a week, and the mayor, who are on all the time, he seconded it. Brad asked, and we get this a lot. He asked, he would like to know how myself and you invest, and maybe give us a run through of the routine and make specific investment decisions. I mean, we read the disclaimer every morning. Dimitri and I, if you don't know, are the co-founders of Market Chameleon. We present every morning this show because we want to show people how to navigate, but we have to be super careful about, we're not giving investment advice, right? So the last thing, we can't show how we trade, because there's liability risk for us, right?
And
our trades. I mean, we do it with, we're doing episode. Jake has been nice enough to come on, and he's showing how he paper trades. And, if other people want to come on, we can talk about what they're doing and things. And we do show how to navigate the chameleon, but ultimately it's up to you, the chameleons, to make decisions. We can't really show what we're doing every day, unfortunately.
Right. And you got to think of it, what we're doing is showing you tools to assist you. There's no way, you would even be able to follow a trade of, that's not even practical, and just to give you a background, Will and I, and our team, we were broker dealers at one point. We had Series 7, Series 24. We're licensed. We're not, because we were playing the role of a broker dealer and a market maker. And you got to be careful, because we're not trying to we're not telling you what to do. We're not, telling you to do this trade. We're just showing you tools that can assist you with. And that's the more important part, because I think a lot of people, they want to, they tend to want to say, well, there must be an easy way. Just show me like these 3 buttons to press. But it's not like that, because trading is dynamic, and factors are always, there's a lot of factors going on, a lot of information coming in, and you have to learn from experience and knowledge how to use that to your advantage. And it's changing. So let's say you ask somebody, well, just show me how you play a perfect chess game. Well, there's no way for me, you could watch me do it, but it's reactionary, right? And chess has a much more controlled, limited environment. There's a lot of different moves there. There's a lot more variables in the stock market, and you're just reacting a lot of times to the information coming in and getting that data, and that takes experience and knowledge. So there's no one thing I could show to say, yeah, I think like there's a tendency, just show me this one thing to do and I'll just keep doing it, pressing this button when this happens, and it'll add up. But it doesn't do it that way. Like, think of a chess game. There's no, 10 moves and you win every game. It doesn't work that way. And you're reacting, to things that are constantly happening, right? Even when the markets are closed, there are constantly new information coming in, new data coming in that you could absorb and try to figure out, how to position yourself in the best way. And that takes, it takes experience, it takes education and knowledge, and it takes learning how to do things on your own. Okay. There is a solution for people who don't want to do it, right? There is a solution, and it's called a hedge fund. You give a hedge fund your money, they do all that work for you. They have a model 2 and 20, right? So they take whatever money you put in there, they take 2% management fee, and then 20% of the profits. That's the fee, right? That's the fee for somebody to do it for you. That's the fee for, you have a professional watching. They're not going to call you, they're not going to call each client telling them you have to do this. That they take the money and then they consolidate it and then they manage it. That's a hedge fund 2 and 20. If you're trying to learn how to do things yourself, it's more of, looking at the data, getting experience, and figuring out through your experience over long term the best way, to position yourself and what the markets are doing. So
and certainly you can learn from other people's trade. I mean, that's one great thing about the Discord group. I know both Raj and Jake have mentioned they discuss trades, right? And they follow the trades, and people talk about it. And certainly you can ask questions about trades and things that you're seeing, and we can discuss them.
Right.
We just, anyways, it's showing paper trade and stuff like that for Dimitri and I we've been advised it's just not something we can do.
Yeah,
and I just wanted we haven't discussed that in a while, and we always have new users coming in, so I just wanted everyone.
Yeah, and it's a little bit, look, it's a little bit if, for example, if I did a trade and then I said, here's a trade, and people start piggybacking, right? Well, what happens is I created an unfair advantage for myself because I'm the first one to do it, right? That's the problem, right? I'm the first one to do it. And then if people are piggybacking, I already kind of created this edge. Like, think about Warren Buffett, right? Warren Buffett, he has this edge that he created because he's the first one to invest in the stock. And when those SEC filings come out, people are going to piggyback on it, and it's automatically going to be at a higher price than he paid, right? He's got that edge already, but he's not even, it's just happening there naturally because you know, he has to do that filing. People are going to find out anyway, but he's got this small edge because he creates this demand for something after he does the trade, so there is that conflict there as well that you want to kind of avoid. But what we're trying to do is show you, you know tools to help you in the long term, you know to you be your own person, your own decision maker, you have to have confidence yourself in what you're doing, right? That's the key part, is being confident in what you're doing and knowing what you're doing and gaining that experience, that you're going to recognize things yourself. You don't need somebody to tell you. You're going to be able to do it, but it takes experience and time and knowledge.
Perfect. Well, we've spent 4 minutes on this, so let's move on. How about we do have a question. Can you show how to screen for credit put spreads?
Yeah, let's do. I mean, that would take me. Do you have anything that would be more of a
That's it so far.
like I could answer in 2 or 3 minutes? Like not as general, I could do it, but I have a lot of videos. If you want to see how to do it, if you go to let me see, help. All right, here's video guides. I'm going to go to options trading just to save time because it's already there. Strategy screeners, your credit put spreads. And if you go under there, you got, look, 1, 2, 3, 4, 5 videos just under there. And I have a lot more. So, I could do that and they're already there. So just maybe to answer questions that, more specific instead of just a general one, I think I would rather do that right now.
Yeah, well, I think the person asked, he wanted to see the top 5, how you would analyze the top 5 credit put spreads.
Okay.
I mean,
there's always, that's another question. The top 5 by what, right? So I think a lot of people say, give me the top, but you have to define top by what, by theoretical edge, by, seasonality, by the ones with the most cushion. So you have to define what do you want top by. It's very general, right? So I wouldn't be, I could show you different ways of top this or top that. The questions become so general that I have to guess what you're trying to do, right? So, top earnings plays, there's so many different ways that you could filter it out. There's an unlimited here.
Wait, you can screen the top credit spreads by earnings that are coming up?
Yeah, you could screen just for earnings, right? Or you could screen just for ETFs, or for spreads that are not that don't have earnings coming up, that earnings pass and you don't want an earnings play, right? So you could do all those. That's what the screen is for, but you have to there's no button top 5. These are the top 5. That's it. Don't ignore everything else. No, there's no such thing. If there's a button like that, then obviously I would just tell you, here's top 5. Don't even screen. Like, all this other stuff would be useless. But it doesn't work that way. It's like you have to define. So I could say, give me the top ones by theoretical edge, top ones by historical win rates, top ones by the return if the stock remains flat. I could do it this way. I could do it by expiration, or I could do it by expirations next 30 days. I could do it by top 30 to 60 days out. That's what the filters are there for. You define what you want, right? And you keep filtering it out. So I can't tell you, here's the top 5, because you need to define what, by what, like, give me the top 5 stocks. What does that mean? Top 5, top market cap stocks, top, growth stocks, top, lowest volatility stocks. You have to define, what do you mean top? What does top 5 mean to you? Does that make sense? I can't tell you. Right. So And hopefully, you know, that's why we created these filters. So there's no button top 5. There's just filters to narrow down the top, you know, and you could sort them. So like, for example, here I pick, give me the top ones in the next 30 expirations, next 30 to 60 days, and the best return if the stock is flat or goes higher. So then here you go, you know, this is a 61% return, 56, 61. These are the credit put spreads. Or I could change it. I could say, well, give me the top ones by downside cushion. So this one provides me with the most downside cushion. Basically, these are the ones that are, you know, that the spreads are out of the money, right? So the stock here could fall by 17.4% until I break even, 14.5%, 14.5. So that's the top by that. So you have to kind of define it, you know, what you're looking for, and then you could screen for it. But that's what the filters are there for. You know, I could go further and say, I want this, and give me the ones only in the S&P 500, right? Or only in my watch list, you know, or you know, only in a certain sector, or only ones that are market cap 100 billion. So that's how you narrow things down, by choosing the criteria that's important to you. Okay.
We do have a live question. I think the person will come on live. You want to do it? Are you ready for this?
Yeah.
I think, speaking to your mic, I think your mic may be garbled.
Anybody that's signed in.
No, I think your mic, as a D, I think your mic is, you sound like you're underwater, actually.
Do you want me to come out and come back in?
Yep, come out, come back in. In the meantime, I'll bring the person on. All right?
Yep.
All right, I'm going to bring this new guest on. Let's see if he comes in.
Hey there, guys.
Hey, it's Jake. How you doing, Jake?
I'm cool, thanks.
I wanted to bring you in because we did. I know you've got a couple questions for Dimitri, but you piqued everyone's interest earlier in the week about a stock you had an issue with, and everyone was asking what's happening with that. I don't know if you have any update.
Yeah. So that was a while back, actually, quite a while back in November last year. I did a Seeking Alpha post on TAL, which is the Chinese education firm. And I kind of went through the balance sheet, the works, and I ended up being you can see the article's still there. I ended up being very bearish on the firm, but I didn't actually take any position for a couple of months thereafter. And then I decided to load up on 50 puts, so $50 puts, and they were expiring, I think, in January 22. And so, as you guys are all aware, what happened was that the Chinese government decided to potentially make Chinese education firms non-profits or not-for-profits, and everything tanked. So I ended up in a situation where I had a ton of long puts, really deep in the money, and I was kind of worried about what would happen if they delisted, in as much as, well, I could force when I'm long a put, I can sell the stock at that price at $50. But my question really was, well, what happens, in terms of counterparty risk, etc. Now, normally with derivatives, that's the whole point of having the OCC, is to eliminate, counterparty risk. This is not an over-the-counter trade. But I was kind of still concerned about it, and I'd spoken to the guys in Interactive Brokers, and they were kind of non-committal. They just kind of said, well, we're not sure. It really depends what the OCC does. We don't know. And then I had, tons of, this is deep in the money. This is my most profitable trade this week. And so ultimately what I decided to do was just simply close the position and close everything I had. I had some short calls on TAL as well, and I just closed it and booked the profit, as opposed to waiting. The thing that the Interactive Brokers customer service guys alluded to was that they had the same case or potential case with Wirecard, which was well, it's not the same thing, obviously, because Wirecard was a huge German banking fraud, but it was delisted as well. And essentially what they said was, with a trade, a standard contract, a standard derivatives trade where things are marked to market, then if the stock is eliminated and the firm goes bust, then the OCC clears with the cash they've got on hand from the counterparty because it's marked to market. But anyway, I just didn't want to take the risk. I just closed it and booked a mega profit. But I think the most interesting thing about that was actually and go look at it, because it was from November last year. I got lucky, I guess, with my analysis, but worked out well for me.
So D, the question Jake had asked earlier in the week, and we've had a couple chameleons come on and ask about it. He wondered, and maybe you have some insight into this, if you have a short put position and the stock gets delisted and you haven't exercised the put and closed out, what happens to those short puts?
Long put.
Oh, long put. I'm sorry, long put.
So here's the question. You have a long put that's naked. You don't own stock again. So you just bought it, put outright. The stock basically goes to zero, gets delisted. What happens
Correct.
to that? Right.
Correct.
We had this similar situation here. So there is a risk here of not closing out that position. And Jake, I think you did the right thing by closing out. And here's the problem. You can go to the OCC, when Jake was saying, you could go to the OCC and you could look up on their memos how they're going to treat it. But most options, right, do not settle in cash. They could go to OCC and take a look at it, what they intend to do with it. But most options do not settle in cash. And what happens is, if it doesn't settle in cash, at expiration, if it's deep in the money, it's automatically exercised. You're short the stock at that strike price, right? So you shorted it. So that's your position now. You're short a stock. Since you're short the stock, now you need to close out of that position. You need to close out of, or it's in your account, right? You're in account. You're short the stock, even though it's worthless. The thing is that clearing firm, that broker might still look at it, but you still have a position, you have an obligation. So if this stock potentially that got delisted somehow gets reorganized and listed again, that's the viewpoint that they could take. You could still have liability, right? You could still potentially have liability if, for whatever reason, this gets listed somewhere else, right? Now you have this open position and the clearing firm doesn't know how to give you the haircut on it, right? So you made this money, but the clearing firm doesn't know how to give you a haircut because they're like, we don't know what your risk is here. And we don't know how to figure it out, because they can't go and close the position themselves. And they don't know if you ever will be able to. And they might not let you take any money out. Your money might be frozen in there until you figure out where to buy that stock. Now, sometimes they might have another customer that is long the stock. They sell it to the clearing firm for like whatever cabinet, $1, and then they might offset, right? It's possible. But when you're short a position and you can't cover it, you might actually have this, you might not be able to take that money out. I don't know how the clearing firm will treat it, but they might just take the viewpoint and make the argument that, there's no way to cover the stock, and we don't know if eventually, maybe China will change their mind and then it gets listed again, or maybe
Sure.
It gets reorganized and it gets listed again and at a much higher price, and then you have to cover. But they don't know, they're not going to let you close out your position. They might not even let you take out any money until that happens. So you might actually take a winning trade, potentially take this massive winning trade and then your money's locked up. You can't access.
Sure.
So this is, Jake, you brought up a good example where people, you had the best case scenario because you won, right? The thing went to zero. That's if you're on the put and you're not long stock again, so your best case scenario, it goes to zero. but you need to cover it, right? You need to take that position off. You don't want this shorts, liability in your account, that they can't offset and take off the books completely. Maybe after 5 years or 6 years, they'll just say, okay, the stock, it'll never come back. I don't know, but you do potentially. That's why I think that you didn't get a straight answer, and they're going to look at it case by case. Because if they did have a ton of customers who were long it, selling it to them, they might just offset, right? They might just say, okay, we're going to offset you with somebody else. You buy it for $1, they sold it for $1. But maybe they don't.
Yeah.
Then what do you do? How do you take it off the books? So it's a good question, and I think by closing out of that position, you avoided that potential problem.
Well, D, it sounds
just
like
take the risk off the table.
It sounds like you may have had some experience with this, D. This is good information.
Yeah.
It's 9:31 now. The market's open. Jake, thanks for coming on. I wanted to get to your other questions. Jake has some real good questions about the platforms, D. So maybe tomorrow, Jake, if you come on, we can get to those questions. Great job, Jake. D, thanks for doing this again.
Thanks, everyone.
Have a great day.
Great.
You stay safe out there. Have a good trading day, and we hope to see you tomorrow.
Trade in peace, chameleons. We'll see you tomorrow, Friday.